Today we are going to cover law relating to foreign direct investment in India. This presentation is made by Safalata Financial Services Private Limited. The presentation has been issued in the interest of investors. First of all, let us discuss the modes of permitted foreign investment in India. As when we say investment, it includes a capital investment and also a debt or borrowing. It may be direct or indirect route. When we make investment, obviously we will looking for taking back the investment. It may be through a direct or indirect. When we make capital investment, the two routes are available, a direct and indirect. In borrowing, the only interest portion is covered when we take back the money from India. So foreign investment basically allowed through foreign direct investment in automatic route and government route, foreign portfolio investments, foreign venture capital investments, other investments like NCDs, investment on non-repatriable basis which is allowed for NRIs and POIs. So basically, law on foreign investment in India is vast. It includes FEMA provisions like FEMA, issue and transfer of securities by person resident outside India, regulations 2000, and it covers first of master circulars. It also includes other acts like Foreign Contribution Act, Master Circular on External Commercial Borrowings, and SEBI regulations. So basically, when we discuss about foreign direct investment, we will be referring to a host of other acts which also plays major role. There is a investment in firm and proprietary concerns regulations and Prevention of Money Laundering Act. So indirectly, all these acts has got its own impact on foreign direct investment aspect. The eligibility of foreign direct investment in resident entities is mainly covered under Indian companies, firms and proprietary concerns, trusts and other entities. So all these entities other than other entities are allowed to go for FDI. Other entities, FDI is not permitted. So basically, when we discuss about foreign direct investment, either we will be considering Indian companies or firms or proprietary concerns or trusts who can do foreign direct investment in India. Indian companies, of course, they can do foreign direct investment without any limitations. Firms and proprietary concerns, NRIs and POIs require prior permission of RBI for repatriation. Person resident outside India require prior approval of RBI for investment. In case of trusts, FDI interest trusts other than VCF is not permitted, and other entities FDI is not at all permitted. There are few sectors which is altogether prohibited for foreign direct investment. Foreign investment in any form in the business of chit fund or nidhi company or agricultural or plantation activities or real estate business or construction of farmhouse or trading in transferable development rights. All these businesses do not have any FDI permitted operations. Foreign investment in the form of FDI in the case of real retail trading, except single brand product retailing, atomic energy, lottery business including government or private lottery, online lotteries, etc., gambling and betting including casinos, business of chit fund, Nidhi company, trading in transferable development rights, activities are sector not open to private sector investments, and agricultural activities excluding floriculture, horticulture, development of seeds, animal husbandry and related activities for which permission will be approved, but as far as other agricultural activities it is not allowed to do FDI. Manufacturing of cigars, cigar rolls and cigarettes, in this activity also FDI is totally prohibited. Now in order to attract FDI, we would like to discuss the types of instruments allowed. Indian companies can issue equity shares, fully and mandatorily convertible debentures and fully and mandatorily convertible preference shares subject to pricing guidelines and valuation norms prescribed under FEMA regulations. Issue of other type of preference shares such as non-convertible, optionally convertible or partially convertible have to be in accordance with the guidelines applicable for external commercial borrowings. Since these instruments are denominated in rupees, the rupee interest rate will be based on swap equivalent of London Interbank Offer rate, LIBOR rate, plus the spread permissible for ECBs of the corresponding maturity. That has to be considered. As far as debentures are concerned, only those which are fully and mandatorily convertible into equity within a specified time will be reckoned as part of equity and the FDI policy. The conditions on issue or transfer of shares also has been specified. The capital instrument should be issued within 180 days of the date of receipt of inward remittance or by debit to the NRI or FCNR account of the non-resident investor. In case the capital instruments are not issued within 180 days from the date of receipt of inward remittance or date of debit to the NRI or FCNR account, the amount of consideration so received should be refunded immediately to the non-resident investor by upward remittance through normal banking channels. Here we have to specifically should understand the one point, it has to be sent out through outward remittance. There should not be any adjustments through book accounts. Or by credit to NRE FCNRB account, non-compliance with the above provision should be reckoned as a contravention under FEMA and would attract penal provisions. In exceptional case, refund of the amount of consideration outstanding beyond a period of 180 days from the date of receipt may be considered by the RBI on the merits of the case. So now let us discuss in FDI how much it is allowed in each sectors. So FDI is allowed sectors based on the caps. For example, for agriculture, 100% FDI is allowed under automatic route in floriculture, horticulture, development of seeds, animal husbandry, or related activities. FDI is not in any other agricultural sector activity other than the activities mentioned here. Now, as far as industry is concerned, the caps as far as mining is 100%. So, any person who is interested in mining activities in India, they are most welcome. Alcohol distillation and brewing. So, government has permitted anyone to enter in this industry without any limits and caps. Automatic coffee and rubber processing and warehousing, they are also 100% automatic route is allowed, and defense only 26% through prescribed government route. So there is a restriction here. Drugs and pharmaceuticals 100% automatic route, power 100% automatic. As far as service sector, advertising and films, 100% automatic. So if anybody is interested in investing in our channel, 100% they are allowed without any limits. So it is a very big scope for foreign investors to enter into India for investment. A banking 74%, cap is there, FM radio 20% growth subject to government approval. Cable network 49% subject to government rule. DTH 20% government rule, and business services 100% government rule. And commodity exchanges 26% government rule. Construction and maintenance 100%. So Bangalore has got vast scope and opportunity as far as this sector is concerned. So people who are interested, they are very much welcome. Automatic ports and harbors 100% it has been allowed. So development of township, housing, built-up infrastructure and construction development projects 100% they are allowed. So anyone who is interested doing real estate activity concerning the development of township, it has been allowed. But as far as other real estate activities, it is not permitted. Route courier service 100% government route. Health and medical service 100% automatic route. This is a very vast. There is a vast scope for this area. Hotel and tourism 100% automatic route. Industrial parks 100% automatic route, and insurance 26% automatic route. NBFC 100% automatic route. So it is a very big scope here. Print media 26% subject to government route. A telecommunication 75% to up to 49 under automatic route, beyond under government route. So as far as trade is concerned, cash carry trading, wholesale trading 100% automatic route is allowed. Trading for exports 100% automatic route. E-commerce activities 100% automatic. Retail trade of single brand product 51% under the government route. Transport and transport support services 100% automatic route. So let us try to understand what are the definitions so far we have said. What do we mean by these words? A company is considered as controlled by resident Indian citizens if the resident Indian citizen and Indian companies which are owned and controlled by resident Indian citizens have the power to appoint majority of directors in that company. A company is considered as owned by resident Indian citizens if more than 50% of the capital in this beneficially owned by resident Indian citizens and Indian companies which are ultimately owned and controlled by resident Indian citizens. An entity is considered as controlled by non-resident entities if non-residents have the power to appoint a majority of directors. An entity is considered as owned by non-resident entities if more than 50% of the capital in its beneficiary owned by non-residents. Thank you for sparing your time and trying to understand FDI norms